Hi, my name is Jim and I was retired. Well, it's almost too hot to handle. And I'm not talking about the August weather, I'm talking about this crazy economy. One day we're debating whether it's a recession or not, and the next Congress is tackling inflation or pretending to do so. Fed watchers are trying to gauge how much the Fed will raise rates in September by the latest numbers. And I'm going to talk about a strategy that I'm using to tap tax-free cash for expenses while equity and bonds are both down year to date. Stay tuned to this video while I cover everything that's too hot to handle. Speaking of hot news, the Bureau of Labor Statistics came out on Friday with the latest number on non-farm labor force increase, with 528,000 jobs added in July. That brought the unemployment rate down to 3.5%. Now, the job gain was about double what economists were expecting. So it's a hot number, definitely. In these dog days of August, economists and weather forecasts are likely wrong. The strong job numbers ran counter to all of the recessionary talk that we had just a week earlier after the weak gross domestic product number came out to give us 2 quarters in a row of negative growth. But the market had been betting that the Fed, based on that slow growth, would start to slow down its monetary policy tightening. A week ago, after the very weak GDP number, the market, through the CME Fed Watch tool, had the odds of a Fed increase in September at 72% for a 50 basis hike. That was the predominant thinking after that weak GDP number. Well, after Friday's job number, the CME Fed Watch tool now has a 68% chance for another 75 basis point increase in September after the back-to-back increases in June and July. So if you've seen prior videos that I've done on inflation and the Fed, you know that I think we need to stay aggressive. While many on Wall Street want a easing of Fed policy so that the market can revive, I don't think it's in the cards. Chair Pfau even made that clear in his news conference on July 27, when he said another unusually large increase could be appropriate at our next meeting, but he said that the decision will depend on the data that we get between now and then. Well, this jobs number on Friday was the first shoe to drop, and then we're going to get additional data. We're probably going to see another August job number in early September, and we'll get 2 more readings of the Consumer Price Index for July and August, and 1 more measure of the Fed's preferred inflation measure, the Personal Consumption Expenditure, or PCE index. So that's a lot more data to come before the Fed makes up its mind at that late September meeting. By the way, that September meeting will also be another survey of the economic projections by all of the Fed members, the SEP. And we will see where they stand now with these latest numbers on where they think the Fed funds rate should be by the end of this year. Remember, they were looking at a median central tendency of about a 3.5%. We're only 1 point away from that now. That was pretty low, and I think it needs to be higher. Now, Fed policymakers spent a lot of time last week trying to push back on the market chatter about an easing of the Fed funds pace. They especially seem to push back on the expectations that you see in the CME Fed Watch tool that we will see a lowering of rates next year. Cleveland Fed President Loretta Mester suggests that the Fed's funds rate may need to raise above 4%. and that we might not even get inflation down to its target of 2% for another 2 years. Even noted Dove Chicago Fed Charlie Evans said that a 75 basis point is possible in September, but he was hoping for the 50 basis points. That was before that July job number came out. San Francisco Fed President Mary Evans grabbed a lot of headlines with her unfortunate comments. Did you see those? She said, "I don't find myself in a space where I have to make trade-offs because I have enough. And many, many Americans have enough." Good for you, Mary, but many, many do not. Where is that "I feel your pain" empathy from the 90s? In past videos, I've shared a chart that points out that the Fed funds rate has to get above the PCE inflation rate before inflation is contained. That's the way it ran the last time, and I think we need to do that again. Anything short of that, and we're likely to recreate the stop and go policies of the 70s and all of that malaise. I think we will need a Fed funds rate well above 4%, depending upon where that PCE inflation comes in at year end. So all of this uncertainty about the recession and the inflation rate has not been good for the bear market. We keep poking the bear, leading to greater volatility. And with all of that uncertainty, my immediate concern is how to replenish cash in bucket one while both equity and bonds are still down year to date. My bucket system started with 3 years worth of expenses in bucket one, and I'm down to about 2.5 years right now. Now I have cash and cash-like investments that I could draw down in bucket one in my tax-deferred accounts, but I'm going to pay taxes on anything I do there, and I need to keep taxable income low for the Affordable Care Act premium subsidies. And I live in New Jersey, so I'm trying to keep gross income below 100,000 so that all of my retirement income is exempt from New Jersey taxes. That monstrosity in Congress called the Inflation Reduction Act, which is more like the Inflation and Recession Act, does include an extension of the ACA premium credits for another 3 years. I'll have to address that in a future video, but that would solve Marie's problems for ACA coverage for the next 3 years before Medicare. Now, I've also looked at selling assets in my taxable accounts and getting a long-term capital gains. If my gross income is below about $80,000, that capital gains would be taxed at a 0% capital gains rate. So I can look to fill out some of my income need through that. But I'd be selling things that have future opportunities for gain. So do I want to do that? Also, I could take money out of my Roth accounts and be tax-free. All withdrawals from the Roth accounts are tax-free. But again, I'd be selling assets that are giving up the opportunity for upside potential. So what do I do? Well, I was reading Dr. Wade Pfau's Retirement Planning Handbook. Yeah, exciting reading, but it is. I decided to tap one of two buffer assets that I have, the cash value in my permanent life insurance. The other buffer asset is home equity. But let's talk about this permanent life insurance cash value. Buffer assets can lessen the need to tap into your retirement assets in a down market if you preserve them for these kinds of market conditions. I've mentioned before that the only thing I'm doing with the cash value life insurance right now is tapping that cash value to pay an annual long-term care premium. And again, it's an exchange right out of cash value into the premium, no taxable income, and a good add into my security of my retirement plans. But I decided to see what I could do with the cash value beyond that. So I met with my Northwestern Mutual life insurance agent to run a new projection of what would happen if I took out $30,000 in cash value. To extract cash value from the life policy, you generally have two options. One is a loan. You take a loan out, it's not income, then you have to pay interest back according to the contract terms. The second option of extracting cash is to make a partial surrender. Now, the loan has an advantage in that it's not taxable income. It's a loan, not income. But you do need to repay it, otherwise you will deplete the death benefit of the policy eventually. Yet I discovered that the size of withdrawal that I'm making in a partial surrender would also be tax-free. That's because life insurance is Pfau, first in, first out. So the surrender will be a return of premiums, therefore not taxable. Now, life insurance surrenders above principal will be taxable as ordinary income. And you run out of your death benefit, which is why you keep it, right? Well, my agents ran the numbers to ensure that the remaining cash value will continue to fund the long-term care premiums and keep the policy in force to provide a death benefit for Marie. Since, for instance, I'm only taking a 50% pension, 50% survivor benefit on my pension. So having life insurance death benefit will fill that gap. Now, if you haven't considered buffer assets, you might want to talk with your life insurance agent, especially if you have a permanent life insurance policy. Hey, also look into the home equity as a buffer asset. Now, two ways of tackling that. One is a reverse mortgage, and you've seen those heavily advertised for anybody over 62. But the other is a home equity line of credit. Right now, I'm not pursuing either of those options. I'll keep the home equity as a buffer asset. I may look into a home equity line of credit if the rates drop a little bit lower than they are right now. So I'll conclude with my standard warning. I am not a life insurance agent. I am not a financial planner. I have no special initials after my name. So take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one. See you next time.